From a risk perspective, I would tell dealers don't ever reinsure your GAP program.
It's no secret dealers have started facing profitability headwinds and searching for new ways for their businesses to succeed. But one industry visionary is laser focused on creating new profit opportunities. Today, I'm speaking with Tony Wanderon, CEO of APCO Holdings, home of EasyCare, an F&I solution for car dealers. Don't forget to click subscribe so you never miss an episode.
But before we dive into the show, this episode is brought to you by CDK Global. CDK Global has been empowering nearly 15,000 dealers with the tools and technology they need to build deeper relationships with customers. Their team is keenly aware of the state of dealership technology, and while many vendors promise seamless experiences between your CRM, DMS, digital retail, and fixed ops, most of these bolt-on solutions tend to break workflows and cause more harm than good. That is why CDK has launched a new dealership experience platform. This new integrated software consists of everything you need to operate a dealership efficiently while delivering an unparalleled experience to your customers. Basically, everything working together, not separate, one system to run your dealership as opposed to 10. CDK developed it with an outside-in approach, listening to dealers every step of the way. You can learn more about CDK's dealership experience platform by visiting cdkglobal.com/DXP or clicking the link in the show notes below.
This episode is also brought to you by Cars Commerce, the platform to simplify everything about buying and selling cars, including the quote-unquote follow-up. Let me explain. Dealers, fast and effective follow-up is crucial for converting leads into customers. But here's the problem. 40% of shoppers report that they are not getting timely or helpful responses from dealerships. This is a huge problem because your own team could be leaving 4 out of every 10 sales opportunities on the table. Cars Commerce makes it simple to measure and improve your follow-up performance. A Cars.com experience report tracks the percentage of leads your team is responding to and how customers rate those responses. While Dealer Inspire's retailing technology enables your team to quickly text follow-ups with personalized financing options to make the most out of every opportunity. To learn more about how you can measure and improve your team's follow-up performance, go to carscommerce.inc/experience or click the link in the show notes below. Lastly, I want to thank EasyCare for coming on as a guest and also supporting this podcast. Tony Wanderon on the CDG podcast. Tony, welcome.
Thank you. Thank you for having me.
Good to have you on. You know, I was looking at your website. I saw that GWC logo. That brought back some memories from the independent dealership days.
Yeah, we've been part of that organization now myself for the last 15 months, and they're an amazing group of people and spread their wings out through the independent dealer channel and, starting to expand into some of our franchise dealers as well. So excited to hear that you were a customer of ours at one particular point.
Oh yeah, early adopter back in the day. You've had your hands in quite a few things and you've been very successful in many parts of this industry. I found it very interesting as I was looking through your background. You were a part of a Take 5 oil change, just as an example, something that I didn't even imagine. I was like, oh wow, Tony's involved in that. You had EasyCare for, I want to say, close to a decade. Got acquired by APCO Holdings, of which you're now CEO. Can you tell us a little bit about your journey?
Yeah, I'll back up a bit. I started off in the business through an agency down in Miami. And, that company, and I'll go through a little deeper, but that company was acquired by Allstate, and I ran that for 11 years. Left Allstate in 2011 and started a company with my sister, Courtney, called Family First Dealer Services. And we sold that company after 2 years to a private equity group, Trivest. Trivest was our first private equity investor that came in, and they also owned a bunch of other companies as well. And one of them was Take 5 Oil Change. So Troy Templeton, who was managing partner at the time, felt that it would be good for companies within the portfolio to be able to sit on the board of those companies and help drive profitability and business for them. So Take 5 was similar to us on the service contract side, working with vehicles, and working with customers on the product side. So it was more of a relationship through Trivest than it was a singular focus on being on the board of Take 5.
You were the CEO of National Auto Care, got acquired by APCO Holdings. Today you have APCO, you have EasyCare. Can you give us just a clear picture of why this happened? What brought you to this point in your career?
I think as we've discussed, we've been part of a couple of private equity companies. We've done 5 transactions over the past 25 years, and those have accelerated over the last few years as Family First was acquired by National Auto Care and merged in. became CEO of that company. We transacted again 4 years later and sold to Level Minic and grew that business. Through that growth and through that strategy, 4 years into that relationship, we went back to market. And APCO was one of the companies that were very interested in bolting on our organization to theirs to become one of the larger players in the marketplace. And since January 3rd of 2023, we've been part of that organization. I've been leading that company, which, as you said, encompasses EasyCare, National Auto Care, GWC, Relentless, and our most recent Crystal Fusion acquisition. So we have 7 different companies under the APCO holding company name, of which I control as CEO.
Mm-hmm. So tell us a little bit about what do you do today at APCO? You have multiple companies, as you just mentioned. How do all these different companies impact different parts of our industry?
Yeah, so we have a motto. It's like protecting what moves you. So anything that moves, we're looking to protect. And that could be in the RV space, that could be in the power sport position, independent used car dealers, franchise dealers, manufacturers, financial institutions, really the credit unions, the encompassing of all the different areas of support that work within an auto or distribution channel that has a power sport or RV, as I said. So our focus has really been over the past 15 months is to try to bring all the companies together from a branding perspective. We just did a rebranding of our EasyCare brand. Everything will be falling under that. GWC will remain independent from a branding perspective because their distribution channel is within the independent space, and they've grown a very strong brand in that particular area. And our RV and power sport programs operate under our member care program and are managing through our Relentless relationship too, who we purchased out of Indiana. I think it's important to know we've been on a very aggressive M&A strategy over the last 4 years and have acquired well over 30 different agencies and companies to help us grow our business from a organic standpoint and inorganic standpoint.
You said something interesting, which I've been hearing a lot, which is RVs and power sports. Lots of dealers have been asking me about this. Very general questions about what's happening in that market, its growth. On the other hand, I've also seen lots of dealers just talk about diversification in this market, right? There's a lot of uncertainty in the macro, thinking about, EVs, direct to consumer, how that impacts dealers. What type of growth are you seeing in that segment of our market, right? Obviously, it's not traditional automobiles, but just when we think about power sports and RVs, and you clearly have your fingers on the pulse here, what are you seeing in terms of growth?
It's hard to kind of put your fingers around what has happened since COVID. So if you think about what really did spike RV and power sport and marine was the drive around being with your family and by yourself, right? Not going to a hotel, not staying in a crowded place. So RVs exploded. We saw growth 30, 40, 50, 60%, in some cases over 100%, where dealers just couldn't get enough inventory. People were lined up at the doors and they were purchasing RVs or travel trailers, tow behinds, whatever it might be. On the power sports side, people wanted to spend time outside and they wanted to enjoy the time that they had available to them. So power sports really grew tremendously in multiple different areas around the country. As far as the dealers looking for diversification, many of our dealers are in the power sports side, either owning Harley Davidson dealerships, off-road Polaris type dealerships as well. And one of the great things I think of a car dealer going in and purchasing one of those distribution channels is their sophistication and understanding of how to move inventory, how to market their products, how to get digital. And it really does help build their market share. So I think, consumers have grown accustomed to having what they want when they want it. RVs are a little bit different, especially if you're talking about Class A or B vehicles, which are the bigger, larger RVs. They're very expensive. Interest rates have had somewhat of a negative effect on that, but it is an acquisition or purchase that you make because you want it, not because you need it. So you're probably, in those particular spaces, a little bit more susceptible to economic issues that happen and put you in a position to be thoughtful about it. But I think it's a great investment and has been for many, many of our dealers around the country.
Got it. And then what are the general economics of these businesses? Or like, so first of all, two sides here. When I think about your involvement in VSC products, right? We know traditional car sale, you're going for the vehicle service contract. For the gap insurance, you're going for the tire and wheel, and on and on and on. What does that look like on the RV side and the power sports side? Is it similar? Is it different?
Yeah, I mean, the products itself are fairly similar when you look at it from a structural perspective, but there could be some things that are a little bit different and unique because of that customer. It could be towing. It could be because on an RV, think about it, they're not going to be within 20 to 30 miles of a dealership in many cases, or they're traveling during the summer months. So you have to take care of that customer in a different way. They're going to be handled by probably a dealer that's not associated to your store, right? So the products might have different roadside coverages. There might be different limits of liability. And because RVs, when they are built, they're built with different components in every one. Where a vehicle, we know if we buy a Camaro, we know what's in that Camaro. In an RV, we don't. An RV could have 15 different refrigerators in it, different appliances, different mechanisms, different interiors. So it's much more custom, and handling the customer in that perspective takes a little bit longer, but it also takes them longer to have those vehicles repaired, because there is continuing to be a shortage of technicians in those spaces and really all over the industry.
When push comes to shove, do you see that trend just continuing to grow in light of the fact that we're several years past the rush? And I say that growth from like top line sales and also profitability. How do you see that trend continuing?
No, listen, I think dealers are consolidating everywhere. And part of that is consolidating things that are very similar. And again, protecting what moves you or purchasing what moves you seems to be really resonating pretty well in that auto dealer space. Again, I have one dealer who has purchased probably 35 different rooftops, and a half a dozen of them have been Harley Davidson locations. And they're, not only from the profitability perspective, but just from the experience of the ownership of a Harley store and the lifestyle that brings and the different types of events that you can do with the customer there versus what you do with an automobile, I think intrigues a lot of dealers, and puts them in a position to really help during challenging times be profitable where maybe a dealer before that wasn't, or also to be able to expand and get better cost control because of the size of their organization. So it's really not just on the power sport side, it's on the auto side too. Consolidation is here to stay. And I think dealers are looking for good investments any way they can because they have had such great years over the past several years and looking to invest in growing their organizations.
You mentioned the term want to have versus like need to have, and what came to mind right away was I had a conversation with Rick Reichart from Ohio, from Reichart Automotive, and I won't forget he said something that really stuck with me. He said, the power sports business is great, it's strong margin, but you have to remember it's a customer that they want to keep investing in this vehicle. It's not like hey, you buy gap insurance and warranty and you're done. And so really, really big opportunity if you do it correctly. And again, that's the big if, right? Because it is more niche and you got to specialize in it, but really big opportunity. And I think all that said, it just really big testament to continuing to see dealers horizontally integrating here with all these different types of businesses where traditionally it wasn't a conversation that I remember having with many dealers as they spoke about growth. It was like the traditional, hey, let's just acquire a dealership. And another one now it's gotten a lot more creative. I do want to transition to dealership F&I, which is where you spend most of your time. What are you currently seeing in the market today, in the F&I office, our industry, to table set with the audience? Dealer profitability has declined over the past year and a half, about 25% on a net basis. It's still over 2x greater than 2019. It's outpaced inflation. So, and in aggregate, dealer profitability is still doing very well. Of course, a major driver of profitability, as we know, is the back end, the products, and it's not the actual car. And so let's just starting very high level. What are you seeing in terms of dealer profitability trends with respect to F&I, vehicle service contracts, GAP, and all the other products offered?
Look, I think you hit it on the head. It's been coming from where we've come from, where we had limited supply of vehicles. Customers were paying list plus in many cases, and happy to do that. Attachment rates for the products in the F&I department were at peak levels, because I think people had affordability was in line. Interest rates were low. Dealers were experiencing just monumental years. Coming out of that, what we always have told our dealers at that time is, hey, realize that we're going to come back to normalized interest rates. We're going to get to normalized depreciation, which is honestly, in my opinion, the most critical area right now. The challenge that you have is negative equity that's growing on a daily basis. Where you had a vehicle 2 years ago that was worth more than what you paid for it 2 years before that, you now have a vehicle that's probably down $5,000, $6,000, $7,000 from the peak point, and now going into negative equity. So we're seeing just huge negative equity swings, which puts pressure on them being able to go out and purchase another vehicle. Interest rates being higher, which puts it at a more expensive monthly payment, or going out longer term, and then effectively causing that negative equity to even go worse, because you're buying a new car today with negative equity carryover, and then you're going into the future with a lower amount and a higher interest rate. So that customer is going to take longer to come into some positive equity to purchase a car. But overall, dealers are still, as you said, very profitable, primarily focusing on fixed operations. Fixed operations, if you look at the inflation rate on parts, labor, in some cases have doubled over the past 3 years. So dealers are starting to generate vehicles out on the road are average 12 years now. So those cars need repairs, and fixed operations is that place to really kind of drive profitability when you might be having a little bit more of a challenge on the front end side. Not to say that anyone's hurting. We're nowhere close to where we were in 2008 or 9, but we're in a position of kind of change, having to invest in digital retailing, having to invest on the training and development and the regulatory things that are going on in the marketplace, looking for ways to reduce their costs. And that's why M&A and acquisition on the auto dealer side is happening, because you can have synergy costs tremendous if you really do focus your attention on that, and you can drive underperforming stores at a much higher level. But dealers overall are still very strong, and in particular markets, and depending on the manufacturer, if you look at Honda and Toyota, they're still doing really well. We're seeing a pause in EV, which I think is good in many different reasons. But overall, I'd say dealers are they're about 80%, 70% of where they were. My concern would be is that you still see that negative equity drop, as I said, and customers are locked out of affordability and just having challenges with credit.
This episode is brought to you by my very own car dealership guy industry job board. CDGjobs.com, my industry job board connecting the best talent in automotive with the best companies, will remain absolutely free for CDG listeners to post and fill available roles at their companies. This free job board is for anyone in automotive: vendors, dealers, lenders, manufacturers, auto tech, everyone. Already, over 100 companies have posted open positions, including Lithia Motors, Recurrent, Credit Acceptance, Veros Credit, Cars Commerce, Shift Digital, Plug, Fullpath, Westlake, Trade Pending. You get the point. The best part is that when these companies hire through CDGjobs.com, they are hiring the most informed candidates in the marketplace. So don't hesitate. You can add your open roles today by visiting cdgjobs.com or clicking the link in the show notes below. That's cdgjobs.com. You have multiple VSC companies under your roof. Why do you think the pause in EVs is a good thing?
Well, from our perspective, I don't think anybody realized what the true risk was. There's all this comment around how EVs are much less costly to drive. Well, our average claim on an EV is $11,000. Average claim for an MBI for a service contract claim. So you're talking about much more sophistication, much higher cost for components, much longer it takes for parts to come in on EVs. Some technicians are not as experienced as probably they need to be, and will be as time goes on. But what's happening now is I think it really does. We've gotten to a point of the cost factors are just so out of whack, and that's why I think you're seeing these slashes in incentives, or reductions in MSRPs on a lot of these vehicles. I mean, if you look at Tesla's taken 3 or 4 rate or cost reductions over the past 6 months or so, 12 months. The market's just changing dramatically. I think what the factories are trying to push on the dealers to really invest in their facilities for EV has taken a little bit of a pause. I think they're great vehicles and they'll be there forever. They're not going away. But I think it takes a little time to kind of ingest it, understand it, and really start to determine what the risk is of selling the EV versus an IC unit.
Do you think, based on what you just said, what's driving these costs, right? Or I guess first question is, what's your average claim on a non-electric vehicle, whether it be hybrid, which is partial electric, or internal combustion? What's your average claim there?
Between 1,500 and 2,000.
Wow, so that's very meaningful. I mean, that's like over 5x greater. Now, so what's driving that? Like, is this something that you think the market can over time absorb and just get better at, and it comes down significantly? I mean, what's really driving that 5x increase?
Yeah, look, even when I see, so I can go back, and I've been doing this for 37, 38 years now. Any new component that would come out new, so when you went from a standard headlight to an LED headlight to, now what we have, those lights went from $100 to $1,000 because there was no aftermarket ability. So their cost was what I wanted to set it for, and how much over time would it come down by another competitor coming into the market to replace those headlights. Just take as an example, 10 years ago, you didn't really have this brain unit with an 18-inch screen on your dashboard. You had analog and older technology that was in those vehicles at that time. Now we're seeing, if we lost a radio before, it was $200, and now it's $2,500, right? If that radio goes bad, that's really tied into the overall control system of the vehicle. So the sophistication and the lack of aftermarket products put us at a peak point. I'll use an example. When a new technology comes out on a TV, it used to be you buy a 55-inch TV set for $4,000. Now you can buy them for $400 or less with better quality. So competition drives down cost. I would expect that they would happen over the next several years on the EV side too. Right now, buyer, in my mind, would be buyer beware. And if you do buy it, you should buy a service contract.
Yeah, look, I think technology, to your point, is generally deflationary. There's this cool chart online you can find where it shows you like the prices of things over the last decade, and you see just like TVs, computers, everything just plummeting. So technology is definitely deflationary. But I want to think from an optimistic perspective. Like, do you have any dealers in your network that are using your products and doing very well with EVs? Like, where's the opportunity? If I'm putting my capitalist hat on right now, and I'm saying, okay, so clearly I've spoken to many dealers that are just not touching EVs right now. If you listen to my prior podcast from last week, the dealer on the pod specifically said, and by the way, very sophisticated Toyota dealer, very data driven. He's like, I won't touch it. And when I hear that, I think opportunity. And so what are your thoughts on this? I mean, are there dealers that are outperforming in the EV space? How are they doing it? What's your take?
Yeah, so last year I was out in LA with one of our larger dealer groups, and they made a comment, we're opening up an EV used car lot. Because finally, if you think about it, how long has really Tesla been out there marketing? Maybe 7, 8 years, truthfully. So most of those vehicles are leased. Almost all of them were leased if they didn't pay cash for them. So, when you look and you see that there's no used cars, there's not much you can do with them because you really didn't have any EVs to distribute up until the last couple of years when they've started to come into play, right, for the OEMs, the normal OEMs outside of Tesla. So I think the opportunity is EV is needed out there. The value's depreciating down to a level that Tesla's probably eating the residual value difference because those leases come off lease and those guaranteed residual values are probably below where they expected them to be. Those vehicles are now becoming much more affordable on the secondary side to a consumer than they were before. So they might have been 40,000 a year ago, they came off, and now they're 25,000. So I think from an affordability perspective, a customer need, and some people are very much not going to drive an IC unit. They're going to want EV. And you need to present them with that option. The only caution I think a lot of us have in the industry is how is that vehicle taken care of? What's the longevity of that vehicle? What are the repairs going to continue to cost, right? How happy am I going to be able to source parts for that vehicle when a customer has a problem? Because they're surely not going to be mad at the manufacturer when the vehicle's not ready. But when you bring that car into that dealership through that service drive and it's sitting in their shop for 2 to 3 weeks because of because they couldn't get the part, they're going to blame the dealer and they may not come back and buy a car from them. And that's why I would imagine your dealer that you talked to last week had that concern was, does it hurt my brand? Does it hurt my reputation? Am I able to support the customer the way that I support them on an IC unit? And, that's right now probably a little bit suspect. But to your point, sometimes it's good to go on the opposite direction of others and set that up and drive that market opportunity. And EV could bring that out there. I'm not diminishing it at all. I'm just saying, think about the costs that are associated to it. Think about the impact of your brand. Think about the investment you'd have to make. And you also need to think about how quickly that car could depreciate if Tesla comes out with another $5,000 reduction in their MSRP.
Yeah, well stated. To your point, I think that there's always opportunity. And so hence why I was curious from your perspective, what that looks like. I do want to talk about non-EV for a sec, right? One thing that I appreciate about VSC companies and when you offer vehicle protection is that your interests are aligned with the dealers, right? There's other businesses in our industry where the dealer and maybe the vendor are conflicting and don't have aligned interests necessarily. But here, right, the more a dealer sells, the better it is for you. And of course, the fewer claims in the long run, the more profitable everyone is. It's great. How are you working with dealers to really create the most profitable experience while selling these products and while selling the VSCs, while still managing a great customer experience, right? Like how are you doing that entire process? And again, I have to imagine you're working with thousands of dealers. And so can imagine that this is probably systematized, but what does that look like for you?
It's interesting. We do business with thousands of dealers, as you said, some of the largest dealer groups in the country and some that do single digit sales per month. The reality of it is our focus needs to be on the customer. From our perspective, we're a partner with the dealer and working with them on helping them increase their profitability, but also helping them increase their customer satisfaction and the experience that the customer has when they come into the dealership, right? Trying to put them in the right vehicle, trying to put them in the right lending environment, the right terms and conditions and products that fit for them. But our main goal is really to partner with the dealer to determine what their goals and objectives are, focus our attention on the F&I office as a primary focus and training their F&I managers, product, how to present, needs analysis, follow up with the customer. But it doesn't just stop there. It really does encompass the entire organization. Several years ago, one of the things that I've always felt that we've done a very good job with is finding different things to help dealers support their overall profitability and to solidify our relationship with that dealer. So we started investing in fixed operations training and hiring a team to come in and really start to work on not only how the customer is when they're in the showroom, but how we're treating them and offering them value-added products within their service drive area as well. That then expands out to how do we handle really multiple products. So we've made, as I said earlier, about 35 acquisitions over the last couple of years, and our most recent one, Crystal Fusion, provides a much different level of protection than our other products. So we're trying to always fill the bucket back up with new products that fit for the customer of today and their driving experience, and also making sure that we're hitting our number one goal is to put the customer first in everything that we do. And it doesn't matter what part of the dealership it is, from reinsurance to F&I development to fixed operations. We focus our attention on really what the dealer needs. And while there is a systematic approach to that, it's also individualized as well for each dealer. While there may be similarities in the dealer, there might be differences in how they present to their customer, what products they would like to put on their vehicles and offer their customers. So, you got to listen, you got to hear, you got to really focus your attention on the need of that one particular relationship versus trying to say, hey, you're a cookie and we're going to cut it up the same way for everybody. That's not how we do it.
So my SparkNotes version of that is lots of process, lots of training, which, okay, makes sense. Now, is that the key difference you're seeing from dealers that are overperforming versus underperforming in your market? Does it come down strictly to process? Is there anything else?
I mean, number one, it's the dealer. It's the direction that dealer, that owner has and how they want to treat the customer and what they want the customer experience to look like. Not only their customer being the one purchasing the vehicle, but their customer being their employee, right? And what value can we bring to that individual when they come in? From our perspective, if somebody new comes into a store, our goal is to make them better than what they were and better time and time again that we spend time with them. But it really does come down to ethics. It comes down to disclosure. It comes down to commitment to the customer. Because at the end of the day, the most expensive thing that you can do is not treat your customer correctly. It costs dealers $1,000 to try to get that customer in the door when they're advertising, promoting, expenses that they're having to put into play. That customer needs to come back and buy again and again, getting them back into the service drive. To your point earlier about Harley Davidson and Riker, that brand experience brings that customer back in, that they're buying T-shirts and they're buying aftermarket items for those units. And we do the same thing on the auto side. You should be proud of the brand that you're driving. And if you are, that excitement, I think, really kind of is brought from everybody that that customer's in touch with, be it from their family, their friends, and anybody they know, to tell them, where they got that car and how they were treated. So the best investment is taking care of that customer.
I can't tell you how many customers, and most dealers listening to this can resonate, but I can't tell you how many customers we've had over the years that maybe their VSC expired or who knows what happened, and you still take care of them. It's really important to just view it as a marketing expense at the end of the day. It's the cost of keeping the customer happy. And even though you may be correct, and maybe, they've had the vehicle for X amount of months at this point and whatever happened, and they're, maybe they did something incorrect, whatever it may be. But at the end of the day, you have to just think with a long-term mindset. Is it really worth it for me right now to have, a detractor and on the street, a hater, someone that is just really upset, talking to, 10 different people, posting on Facebook, posting on Google? There's a fine line, and many dealers have different tolerances for this stuff. I would tell you, I had a pretty high tolerance, meaning I would really, really want to take care of the customers, even if I knew that they were probably wrong. And it was because I really cared about a reputation. And so for me, it was investing in the long term, in the long term, and thinking about, okay, how can I really make sure that, they leave off happy, especially if it's something that's manageable, and maybe I can just allocate, a reserve account on a monthly basis for these types of situations. So that's how we dealt with it. And I'm sure you've seen many other dealers that do the same.
100%. And that's always been that way, that you made exceptions for a customer. Is it the one that screams the most or the ones that need it the most? I think there's a little bit of a balance that you got to look at. But the reality of it is that in today's world, customers have a voice, and it's way bigger than their voice used to be, right? So if I'm looking to build a relationship with consumers within my geographic area, I need to be concerned on what they say and how they talk about us. And that is really something that if you try to do the right thing, because every customer, on a claim, if you don't pay 100% of it, they're not happy. They're going to complain. But the reality is we might pay a $4,000 claim and they have a $250 uncovered component or part, and they are not happy, and the dealer eats that $250 or we eat that $250. But, to your point earlier, it is critical, more so today than ever before, to make sure that you're thinking about that customer and what they're saying about you, because it has ripple effects that can really negatively affect you for not just today, but for a long period of time.
Tony, you mentioned when I asked you earlier about what are you focused on and in your interactions with dealers, you mentioned that exploring new products. Are there any new products on the horizon that you're anticipating, areas that you're looking into?
I think when you think about the products that we offer, everybody makes comments like gap is commodity, service contracts, just a commodity. So what's different about you? What things do you do differently? And, the reality again goes to, I think all of us in the industry that are at the top tier are looking to do the same things, offer similar products. And if a new product comes out, and I've developed a few products on my own and brought out to market, you got fast followers. If you're a leader, usually it takes you a little bit longer because you're the first one to market and you're spending more money on advertising and marketing it and trying to get it into stores and changing kind of that shelf life. There's only a certain number of products you can sell to a customer. They're not going to buy 13 different products. I don't care who you are. And if they do, there's a problem. So you want to make sure that, they're getting the right thing. But at the end of the day, how I look at this is that if you got a head start, you only got it for a minute. And if you got it for that minute, you better take advantage of it. And right now, to me, the one thing that really stands out is the lack of understanding of the risks that you have as an owner of a vehicle today because of the connectivity of that vehicle to anybody that wants to hack it. And while it's been discussed, there's going to come a time where we're going to have some type of a hack that's going to be a little bit more broad than one individual car or two individual cars that will, gather some challenges. The other piece of that is all the privacy requirements that we all have. And many dealers have taken that into account of when you trade your vehicle, and most likely you haven't cleared any of your contact information or all your personal information that might be on the vehicle, and they're wiping it out. But you need to be very careful there too, is that you're not selling cars that have personal information in it from the prior owner, and make sure that we basically start to build these products that really cover your vehicle, not only from the component perspective, but the external threat perspective, that could come from hackers or anyone that could take over your vehicle.
So is that what you're thinking about nowadays, or do you actually have products that are tackling these issues already in the market?
We have products that are tackling that issue. The challenge becomes shelf space, right? And think about when the financial crisis hit, Hyundai came out with an insurance program, right? That said, if you lose your job, we'll make your car payment for you up to 12 months. While that was out there before, that really 2008 and 9 to go through that financial crisis drove Hyundai to be one of the top performers during that struggling time, right? So there may be a product out there that's a need, but it's not enough need for the customer to invest in it yet. And to me, it's probably the cheapest time that they can invest in it because the unknown risk out there's going to be an assumption of what the cost might be, but it's not been determined yet. So I would imagine one or two events that happen will turn the product on pretty high level. And dealers that are proactive and thinking about it, we've even built things where you can build it into the purchase of the vehicle, and we give you a free year of coverage, and making sure that not only your car is covered, but any car in your household is covered as well.
So given what you just said, right? Given lots of these products are commoditized, what is your edge? Like, how do you grow? I want to get deep into your mind of a CEO of a company like this, and how do you continue scaling the company?
I think it all kind of comes down to the people that are within that organization and the investment that's being made in keeping the products and the services up to date. We're in a more regulated environment than we ever have been. So making sure that you choose the right company that's going to not only support you from a product perspective, but also more importantly, from a claims perspective. What dealers are buying from us are our support and product mix, but more they're buying security and knowing that we're going to be there to take care of their customer when they have a claim, right? And that because we become part of their overall experience of purchasing a car. And really the one that is the most challenging for a consumer is to bring, or an automobile owner, is to bring that vehicle in for a repair. So if we're not taking care of it the right way, working with their service advisors, making sure that we're getting them the right components and approving it in a very efficient manner, That's not a commodity. That's a service that needs to be upheld. And the investment that we have to put into all the regulatory environments that are out there now that are, coming at dealers left and right, that we're making sure. But number one, how long have you been in the business? Can you support us as we grow? Are you going to make sure you support my customer? And when I call you at 2:00 in the morning, you're picking up the phone because I'm a partner, and trust me, dealers will call you no matter what time of day it is if you're not doing your job right.
You mentioned the word shelf space. I think about this a lot, right? You, like as a dealer, I can't sell all the back-end products in the world because I'm limited by what the lender, right, allows me to, or the amount of, room I have in the deal, right? And for anyone listening that's, maybe has never been on the F&I side or is not in management, you sell a car, you can only sell X amount of products in the back end, 2,000, 3,000. You're capped, right? You can't sell unlimited things because at the end of the day, the payment goes up and a customer can't afford that. So a thought I had was like, is there a world, right? Talking about like, how do you build a competitive edge? Is there a world where someone like yourself acquires an actual lender and plays around with the margin where you're actually lowering your interest rate, but you're increasing your back end availability for the dealer? So it actually makes you as the VSC provider more competitive because now I can sell more VSC products if I sell with this lender. But net, it makes the VSC company more profitable because it puts more product on the street. Am I like in like cloud 9 right now? Or is there a world where you can actually, basically what I'm saying is there a way to create more shelf space in this industry? Or is it, there's no way, this is, we're at a fixed amount and the only way we're going to put more product on the street as, a vehicle service product or whatever it is by eliminating another product? What are your thoughts?
A lot to cover there. One, I think if you really do look at it, there are service contract providers, administrators that are owned by the OEMs, right? And those OEMs are the finance source as well, right? I mean, in my earlier career, we had Nissan was a client. We provided third-party field support for them. We marketed their Security Plus product to their customers. Their field force was ours. We were connected there, but from a risk perspective, you really have to look at both of them separately because the financial risk, even though your margins may increase because you get a little bit, you're still having competitive pressure coming from independent companies like ours. So you've got to be cost effective so your margins really aren't going up that much. You've got to be, credit quality needs to be in place. One of the things that we've done over our career is worked with pretty much every financial institution and lender and provide a gap or some product for them to embed in their loans or market it under their brand name. And, again, I think it's a great way to generate additional revenue for yourself, but the two factors are completely different. To your point around, I only have one time to sell, that's true. And what we've tried to do in the industry is put together bundled products that might have 3 to 5 different types of coverages in it. So it's on one form. But to your point earlier, you do get capped from the lender, right? And how much can I sell? The one thing that I think dealers overall need to do a better job of is after sale. After the sale of the vehicle, the customer, in most cases, 30 to 40% of the time bought a service contract. There's 60 to 70% of them who didn't. So, there's ways to market the program, which we have and other companies do too, when their manufacturer's warranty come to expire, offering them another chance at it with a finance plan that, they can get their products more cost affordable. Every time a customer walks into that service drive, there's an opportunity to sell them something else. It could be windshield protection. It could be ding and dent, right? It could be multiple different things. The challenge is a service advisor's tapped out sometimes, doesn't have the time to offer it. They're not really in the sales mode. They're in the value quicker mode. So some of the technology that's embedded in the vehicles today, you can extract information out of that, find out how many miles they have, and do some very targeted marketing. And also invest in your digital marketing as well, too, and making sure your websites are up to date with the products that are out there. Because today I might not think it's important, But after I brought that in for a warranty repair and it would have cost me, $5,000, that service contract sounds pretty cheap right now, doesn't it?
Oh yeah. But you just said something which I love, which is the after sale upsell or whatever you want to call it, right? Which is 50% of people don't buy that VSC or whatever, 40%, 60, it doesn't matter, but a very large percentage. So first of all, going back to my prior question, right? The answer is, Yossi, don't quit your day job because that is not the way to put more product on the street. But then fast forwarding, it's like, hey, instead of looking at the direct ability of creating more shelf space that way, there's all these people that didn't buy that product for X, Y, and Z reason. So my question on that is, how do you actually measure that risk, right? Lots of dealers are reinsured, which means in simple terms, right, they have their own VSC company where they share profits or they share in the underwriting profit and loss, of course. So how do you measure risk for someone that did not buy a VSC at point of sale and now wants to buy one? How do you actually do that?
Yeah, I think two factors there. One, are they still under factory warranty with maybe 6 months to expire? So you're not getting a vehicle that probably is going to have pre-existing condition, right? Usually where you do have claims problem would be a high mileage vehicle that doesn't have a service contract. You sell them one, they have a claim within a week or two, and it's a fairly large one. So you need to go through the inspection process. You need to qualify that vehicle. If I have that customer in my service drive, I can qualify the vehicle, do an inspection, and offer the program to them with more coverage. If they don't have an inspection, you sell them a product that has a little bit less coverage. And the reality of it is that our job is really to be able to provide the dealers what their loss ratio is, trends by part, by service advisor. We provide very detailed information to those dealer-owned captives, those owners, so that they can see where their claims are coming from. And if we need to, we either cease marketing the product in that area, or we increase the premium, or we reduce it if the loss ratio is looking, pretty good. So, I don't think there's bad risk in many cases. It's just bad pricing. You need to put more into that reserve account. But one thing I'll tell you is, I don't know how many phone calls and TV or radio ads have you heard of somebody selling a service contract. I mean, I don't think I can get in the car and drive my 7 miles to work and not hear 2 or 3 of them. So those guys are making money somehow. And that really is something in my mind that should be going to the dealer. And they would be they'd be taken care of much better than these independent shops that are out there selling through radio, TV, and late night ads.
Where are these? I know exactly what you're talking about. I've seen these ads a ton. So they're very heavy in marketing. But like, who are they really after here? I mean, are they after the customer that did not buy at the dealer, or are they after the person that's owned that car for 10 years and thinks that they need a repair and they're like, let me go, get after the VSC company because they'll pay for my damages. I mean, who is that customer? Is that really an opportunity? Here, let me qualify that with one more thing. Just one more thing I want to qualify. So the last 5 years, what you've seen a ton of is like, we'll buy your car, right? It started out with We Buy Any Cars. And I know CarMax has been doing it for like 50 decades, but for the most part, it was We Buy Any Car was like the big one. And, of course, then you had CarMax, Carvana, and then it kind of, dissipated into the dealer community. And I don't think dealers did it for extra margin. I think dealers did it because they needed the cars. That was the forcing function, right? It wasn't, hey, you can make a little bit more money. That wasn't enough of an incentive for the average dealer, in my opinion, right? It was, hey, you can sell more, you need the inventory. This is how you're going to get it. So what is it going to take to get dealers to do the same thing for what you just mentioned?
I think what ends up, your original question was, what kind of customer is buying this product? The one that needs it, most likely. The one that feels a higher mile product that, they're having a little bit of a problem. I'm not going to say this happens with all, but maybe a very hard close environment with a monthly payment that is spread out over 12 to 24 months. The affordability becomes a challenge. Cancellation rates are really high. Denials of claims are high. The best place to buy a service contract is from your dealer. I don't care who the administrator is. I don't care if it's an OEM program or an independent. That dealer is invested in you more than anybody else from an ownership perspective. The independent companies like ours that might sell, which we don't, sell directly to the consumer, have to transact at a higher price because their closing ratios are in single digits, low single digits. So instead of them being able to sell something at a more affordable price, they're having to sell it at a higher price. And I just, the cancellation rates on them are very, very high. The loss ratios are usually very high. The only way that I see it really working well is, number one, you market your product to that customer when they need it. And that could be a year from now, 2 years from now, or 3 years from now. And you really then provide them a cost that's effective. If not, like I said, we're developing, and some companies have it, this monthly or quarterly or semi-annual service contract that becomes much more affordable for the customer today, so that when they do get into a little bit of a financial situation, they're not canceling that credit card recurring payment. They're keeping it because it's of value to them and it's cost affordable. So I think it all really does come down to, if you look at penetrations on vehicles that are financed versus not, almost non-existent when you have a cash customer, because it's a check out of their pocket for today, versus you're able to spread it out, that service contract or gap or whatever it is over the term of the contract. So that cost affordability monthly is the most important factor that I find for any of the products that we sell to the customer.
Tony, do you find lots of variability in profitability between dealers, or should I say profitability percentage? Right. I remember, again, I'm thinking back to our reinsurance company, and I was always told you're performing super well. I think we were at like a 40% loss ratio or something. Now, mind you, we were selling off-lease cars, 30,000 miles, factory warranty, right? So these weren't 100,000 mile cars, and so, or 30 to 40% loss ratio, I should say. And of course, that kind of oscillated over time. But is there a benchmark for anyone listening to this, if they have a reinsurance company, or if they're just curious about the economics of running a automotive warranty company or selling automotive VCs? Is there like a benchmark? What does that look like?
Yeah, I think it depends on the manufacturer and the area of the country that you're in, the credit quality that you have. To your point earlier, your credit is going to be driven on what the advance would be. So you better your credit, usually you get a higher advance amount. I think when you look at the captives, the dealer-owned captives, they're extremely successful for dealers. And loss ratios range anywhere from, to your point, low 40, but that's not normal. Normally it's in 60, 70, 80% loss ratios. That's typical in the insurance side of the business. And it really is, again, driven by the work that we do for our dealers and the partnership that we have to really go over where their losses are trending to, and making sure that we're doing the right thing and pricing the product the right way. But it ranges dramatically depending on the area of the country and the dealers. I can tell you, in windshield protection for us in Texas, 7 to 8 times higher in loss ratios than it is in Kansas City, in Missouri. I mean, so just the dynamic, even any of the other products, the dynamic of it is much more dependent upon the area of the country you're in.
Yeah. And I should also qualify that with, it comes down to, from my experience, how much money you're spending in recon, first of all, right? You're spending more money in recon, more preventative. So that's not going to reflect in your loss ratio, but you're going to take that, you're going to make that investment or expense on the front end, obviously. If you're going to, help that customer out and it's not going to hit the warranty, that's an expense. Again, it won't reflect in your loss ratio, but it's still going to come out of your pocket. So it does also, to your point, it does depend on that specific dealer. And then what about gap reinsurance? So we talked about VSC reinsurance. Do you see that is that a pretty popular product? Do you see it growing, declining, indifferent? Thoughts?
Well, I don't know that there's anybody out there that's done gap as long as I have. We started gap in 1983. Saw a little ad in Automotive News from a guy that was in London that was putting together the product and brought it here and put it together. I've been called the godfather of gap for it. I can tell you it's one of those products that you're either making a whole lot of money or you're getting your butt whipped. I'm not into getting my butt whipped. So from a risk perspective, I would tell dealers, don't ever reinsure your gap program. It has too much flexibility in it. And honestly, because a captive has such a consistent, in most cases, a consistent look, you don't have that fluctuation. And that would be, I've never seen dealers get so upset when we've told them not to do it, and they have. And then they say, "Why'd you let me do it?" Don't do it.
I'm I'm laughing right now because I've never reinsured Gap, but I have explored the opportunity, and I I personally I'm nowhere nearly as knowledgeable as you about this. But the reason I never did it was because I felt like I needed to do too much volume to where if there's a very high risk that I'm not going to hit this level of volume, and I shit the bed, and so that's why I never did it. But it's pretty funny to hear you say this because it seems like you have this very strong opinion on this clearly, for good reason. So
There's no doubt. Like, again, if you kind of go back, we sold our original agency administrator to Allstate, took them up at a peak point. We were doing 200,000 gap contracts a month. So we had pretty much 60% of the market at that particular time. And I can tell you it was very hard sometimes having to sit down in front of the people that I reported to and say, we lost a certain amount of money this year, but here's the plan to make it up. And the reality of it was we had such a big market share, to your point around you've got to have scale. We had such big market share that we could raise our prices enough to cover that adverse loss development where other people couldn't do it. They really had to follow our pricing structures. So, today, honestly, Gap needs to go to the next level, which is to start to take risk from a 3 or 4 price product. It needs to get down to make, model, and average, area of the country. It should be priced almost like auto insurance to some degree, and not just be such a fixed price. Now, if it gets to that point, then yes, I'd say reinsure it, take some of that risk because it's much more focused on the risk that's associated to it. Everybody 3 years ago, 4 years ago, are upset because they didn't take Gap. Now they're wanting out. But you can't just jump in and out because you have a 6-year tail on it, right? It still takes 5 to 6 years for those contracts to earn out. So your decision you made 3 years ago is affecting you today. And that's a big part of our business is we have to make a guess, and they call it actuarial science. We have to make a guess of what that risk is going to be like 2 or 3 years from now. Trust me, no one 3 to 4 years ago thought that we'd have inflation on parts 40, 50, 60, 80, 100%. We never thought we'd have labor rates that are now exceeding, in some cases, $275 to $300 an hour. That's what we used to pay our attorneys. But, now that's what that's what we're getting on hourly charges. And
the script has changed.
Yeah, even the complexity of the vehicles now, where a repair used to take an hour, it now is an hour and 15 minutes. So all of that plays into part of loss ratio. But let me see. Don't do Gap.
If I learned anything big, it's definitely that. Although I feel like you just subtly ideated like $1 billion opportunity, which is to create a product like Gap that actually works and takes in way more factors than just like 3 prices. I mean, am I missing something? Is that not a huge opportunity?
No, the problem is that simplification is really critical on the auto dealer side, and really having the ability to price based on the risk is a little more challenging, right? So we don't, as an industry, get down into those finite little things that you look for in auto or homeowners or other lines of business. You kind of generalize it. And if one section of it goes off a little bit, that's where you need to find the right administrator to be able to make that adjustment. So you're not in a situation 2 years, 3 years down the road, you go, why did I do it? Again, Gap to me is the most valuable product to a consumer there is. My point to my dealers, if you're not one of our dealers, that's fine. You should reinsure it, because then you're going to want to come to us and do business with us because you'll be mad at your current provider. In this case, we want you to write it, but we don't think you should take that risk. We can blend it out a lot more balanced than you can in your area.
Well stated. Tony, before we wrap up, general question. What's exciting to you nowadays? What's going through your mind? What are you thinking about?
It's exciting to me to see how the dealers have really started to come together again to focus on the customer as much as they are. For me personally, it's been, as I said, I've done 5 transactions, been part, even though in the same seat, part of a lot of different companies because of the acquisitions that we've made and the mergers that we've done. I mean, I'm excited about the people that we have in our organization, the opportunities that they bring to us as a group. But to me, the most exciting thing right now for us is bringing all these great companies together that we have underneath our APCO umbrella, working with some of the best dealers in the country and learning from them just as much as they're learning from us. I mean, I'm excited about our partnership with Bommarito and the racing team that we're working with, and Jordan Anderson Racing, which, from our size and our organization, we never had the opportunity to do those kind of things before, and we can now. So honestly, I think the auto business is one of the greatest businesses there are out there. They drive so much opportunity for their local communities, and really do a lot of work for a lot of charities around the country too. And while people may talk poorly about car dealers sometimes and service contract providers, I haven't met a better group of people that in my lifetime. So I'm excited about that, but at some particular point, I'll probably miss them too. Maybe not that much, but just a little.
Well, I'm a fan. I'm a big fan, especially the story you just mentioned is about Gap Insurance and your history with it. That's really remarkable. So I didn't know that. If anyone wants to learn more about EasyCare, I have the website pulled up here, easycare.com. We'll throw up the link in the show notes as well.
No, listen, I appreciate the time. And I didn't tell you this story, but I found you on the way on a little golf junket that I was going with my son on, and listened to some other podcasts. And I was checking through his phone and saw you up on and listened to it for about 4 hours that day. Very impressed. Excited to be a part of your organization, what you built in a very quick period of time. So thank you for the opportunity, and look forward to hearing more and more from you as the years go on.
Appreciate you. It's only the beginning. We just launched CDG News and a lot more to come. So we're growing quickly as well. We're having a blast. Tony, thanks for coming on. Had a lot of fun.
Thank you. Appreciate it.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.